Good morning, everyone. This is Rob McDougall from Zhang Financial here with your weekly economic update. Today is Monday, June 24th, 2024. So here's what investors are looking for. You probably heard this from us before, but investors, largely economically speaking, are looking for this to optimize returns, both fixed income and on the equity side, is corporate earnings to continue strong. Now, we're past the first quarter earnings, and we'll be heading into the second quarter. First quarter earnings were outstanding this year, much better than expected, so we need that to continue for equities to continue to work. Also, investors are hoping actually to see slower GDP growth, still positive, but slowing, and at the same time, a reduction in a lowering of the inflation rates, which would allow the Federal Reserve to cut interest rates that they had tightened starting 2 years ago. So that's the Goldilocks or the soft landing scenario. That's what we're looking for every week when we look at financial information. We're looking through that lens. Do these economic data points confirm that we're heading in the right direction towards a soft landing? So last week, how did it look? It was mixed, I would say. So retail sales we had last week were lower than expected, both headline number and adjusted for auto, so that's good. But we had mixed housing data. So in total, the economic data didn't really change things dramatically. But retail sales were definitely in the right direction for slowing but positive GDP. Retail sales month over month came in for May at a positive 0.1%. The expectation was a positive 2%. So that's good. Retail sales ex-auto actually fell. That was a negative 0.1 against a consensus expectation of a positive 0.2. So we'd say those are good data points. Now, on the housing side, is very much mixed last week. Building permits, housing starts last week came in lower than expected. Building permits were expected to come in at 1.45 million. They came in at 1.38 million. Housing starts expected to come in at 1.38 million, came in at 1.28 million. However, existing home sales actually came in slightly above where they were expected. They came in at 4.11 million. So in terms of economic data and their impact on expectations of inflation or corporate earnings or economic growth, last week's economic data didn't tell us a lot, but I would say the retail sales moved in the right direction for lower inflation. So all that economic data that hit last week, when you roll it all up, the Atlanta Federal Reserve, we always watch their expectation for the current quarter GDP, their thoughts on that. So they barely moved their estimate last week. It was 3.1% growth of GDP in the second quarter. They moved that down just slightly to 3.0 based on the data that we saw last week. In terms of inflation expectations, they actually went up a little bit, which is kind of surprising. The numbers didn't really suggest that should happen, but nonetheless, it did go up from 2.23% from 2.17% the week before, but still a 2.23% average inflation over the next 10 years looks pretty appealing. So Fed funds, futures, taking a look at that, and expectations. The next Fed meeting is July 31st, and the expectation of no cut is definitely in the cards. That actually went up the prior week. The expectation or the probability built in was 87.6% of no cut. After last week, now it's an up to 89.7% probability. And then at the end of the year, the odds didn't change dramatically, but they went up slightly for the expectation, which is now the consensus, I would say, is 2 interest rate cuts between now and the end of the year. So the probability of that happening, 2 interest rate cuts, went up from 64.6% to 66.5%. In terms of the markets last week, U.S. equities up, international equities mixed to up, fixed income in the U.S. slightly down last week. So the S&P 500, another positive week, up 0.6%. So year to date, and this is very impressive, S&P 500 up 15.4%. Now, last week, it changed a little bit in terms of leadership. It wasn't NASDAQ. It wasn't large cap growth, which is what has been the case for most of the year. And NASDAQ was actually flat on the week. So what worked last week was value and small cap. Good for us. In terms of on the year-to-date basis, growth and value, slight advantage to growth. But in terms of large versus small, large cap has dominated this year, up over 17%, small cap up a percent for this year. In terms of international equities, when I say mixed, the developed markets, ex-US, flat, up 4 basis points on the week. However, emerging markets were actually up 0.93%, despite the fact China equities were down 0.63% last week. So one thing that's sort of teasing out or becoming apparent here on a year-to-date basis is that developed markets, ex-US, dramatically trailing the U.S. returns. Emerging markets also trailing, but certainly coming back and performing much better than developed markets ex-US, again, with emerging markets up 6.2% year-to-date and the S&P 500 up 15.4%. Last week, in terms of fixed income, the prior week was a huge rally. Last week, it didn't change much, almost no change. So the 2-year yield was up 3 basis points. The 10-year yield was up 3 basis points. So the Bloomberg U.S. Aggregate Bond Index was down 0.15% last week. On a year-to-date, it takes a year-to-date level down slightly negative, down 7 basis points. So this week, in terms of economic data, we would expect this to be a little more impactful than the numbers that we saw last week. On Wednesday, we have new home sales coming in. The consensus is 650,000 new home sales in May. The prior month, April, was 634,000. On Thursday, we get the durable goods and durable goods ex-transportation numbers. They're expected to be lower than what we saw in the month of April. In April, for durable goods, month over month, it was up 0.7. That's expected to decelerate to a positive 0.3 for the month of May. And durable goods ex-transportation is expected to come in at a positive 0.1% month over month for May. Month of April, that was a positive 0.4. Friday, however, this is the big day. It's the inflation day, so we get the PCE numbers and core PCE numbers both month over month and year over year. Now, remember, PCE is used by the Federal Reserve primarily. That's their primary tool, primary data point for inflation, viewing inflation in the U.S. And PCE, their target is 2.0. Now, we haven't been close to that, but we're actually closer on the PCE than we are on the CPI. CPI running approximately 3.3% year over year. PCE is down to 2.7% at this point year over year. So not far away from the Fed target. So in terms of the Fed lowering rates in the future, I don't think we have to go much further on the PCE to allow them to actually cut rates. So PCE index month over month is expected to come in for the month of May flat, 0.0, and the prior month it was up 0.3%. On a year-over-year basis, PCE is expected to come in at a positive 2.6%. On month of April, at the end of April, it was a positive 2.7%. Core PCE, that is expected to come in at a positive 0.1%. Month of April, it was a positive 0.2%. And the year over year, which in April had been positive 2.8%, is expected to drop to a positive 2.6%. And personal income, personal spending, also very important. Those metrics are coming out on Friday as well. Personal income month over month is actually expected to accelerate a little bit to positive 0.4%. It was positive 0.3% in the month of April. Personal spending also expected to be up from the April level. April, it was a positive 0.2%. For the month of May, that's expected to come in at a positive 0.3%. So that's it for the economic activity coming this week, the recap from last week, recap the markets. Thank you very much for viewing. We hope to see you next week. Thank you.